Hey, it's Mike Hambright with Flipner.com. Welcome back for another exciting expert interview where I interview successful real estate investing experts and entrepreneurs in our industry. Today, I'm joined by Jillian Sidoti. She's actually joining us for a second time. She was on almost over 200 episodes ago. She's a partner at Trowbridge, Taylor, and Sidoti, where she focuses on teaching investors how to legally raise capital for their investment projects. As quite frankly, most people are doing this all wrong and in many instances even illegally. But with that said, there are a number of changes lately in laws for raising money that if you're looking to raise money, you need to know about these things. So today we're going to discuss the correct way to raise money for your real estate investing business. Before we get started with Jillian, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days with rates starting as low as 9%. For more information, call 888-296-1697. B2R Finance makes loans tailored specifically for rental investors. They can help you unlock equity from existing properties so you can get cash to grow your rental portfolio. That's huge, and it opens up lots of opportunities previously not available to rental investors. Need a loan? Call 855-819-4412 or visit b2rfinance.com today. National Real Estate Insurance Group is the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. We'd also like to thank Crestar Funding, Mid-Atlantic IRA, and Renters Warehouse. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of Flipner.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Jillian, welcome back to the show.
Hi, thank you so much for having me, Mike.
Yeah. It's funny now because we've just started recently having some people back on the show that have been on before that have lots of other great information to share. And so I was just telling you, this is show number 222. The first time you were on show number 8. So you were one of the very first people on the show at the beginning of last year, I guess.
Well, I am so honored that I am one of the few repeats so far. I'm sure you're going to have many other repeats, but I like thinking I'm special, so we'll go with that.
You are. We're all special.
So no, I'm very excited, and you couldn't pick a more appropriate time to have me here because we do have a big law changing in just 4 days on June 19th. So I'd like to talk a little bit about that and share that with your audience.
Okay, great. Well, hey, before we get started talking about raising money and a lot of the laws that are changing, a lot of the rules that are changing or being clarified and things like that, maybe you could talk about you. Let's talk about you, Jillian. Tell us kind of who you are and what you do.
Well, as you had said, I work for Trowbridge, Taylor, Sidoti. We're a law firm. If you go to our website syndicationlawyers.com, there's tons of free information on there because what we do is we focus on money raising for real estate investors specifically. So, and that's always what we've done. But before I did this, I was a real estate entrepreneur myself. We did condo conversions down in San Diego when the market dried up. Back in 2007, that's when I started practicing law full time, and I still am an investor. We were just talking about investments right before we got on the air. So I still do investing, just more on a part-time basis in a full-time law firm thing. Because as many of you out there know, investing's hard work. It does take time. It takes energy. And I have not that a law firm doesn't, but I do have 3 little kids. And I want to try to spend as much time with them as possible. So I do a lot of my investing passively and my law firm actively.
Yeah, that's great. And so, even since the last time we talked, there's just all these laws that are changing or rules that are being clarified. And it's such a different world today than it was even just a few years ago in terms of raising money, right?
Oh, it totally is. So last time I was on, I probably said some things about how you can't use general solicitation to advertise for investors because that's illegal. And that still holds true to some end, but there's been some fantastic changes in the law where people can now advertise for investors. So before, I would say, like, if you put on your website offering an 8% return on investment, call us to learn how to invest today, that would have been totally illegal to do if you're selling private securities. Now there's some carve outs in the law that allow that. The one most frequently used carve out I see these days is, and I wrote some little notes so people could write it down in case they didn't hear me correctly.
Yeah.
The first one is, you can see that it's 506C.
That's backwards. That's backwards. Did you write it backwards?
Oh, oops.
I don't know how that happened. Okay. 506C. Let's.
I'll have to write it in a mirror next time. So 506C as in Charlie. And what that means is that if you only use accredited investors, and accredited investor is somebody who makes $200,000 a year as an individual, $300,000 a year as a married couple, or has a net worth of $1 million, then they can invest with you. And you can only have those types of investors under 506C. You don't have to get approval from the SEC. You don't have to get approval from the states. You can go out and advertise and say, hey, everybody, I'm looking for investors. But once those investors come through the door, the only type you can take are those accredited investors. And so
that's one of the main differences before is you can just generally solicit everybody now, and then you can only work with them if they fit that criteria. But it
Correct.
used to be that they had to fit that criteria before you could even solicit to them, right?
That's correct. That's
Yeah.
absolutely correct. So now, if you sell securities under 506C, you can use general solicitation. It's actually really nice. I have a ton of clients who are using that now.
Yeah.
So there's that. And then the other one is, and now I have another backwards written thing. So everybody get your mirrors out.
So did you write those backwards, or they just show up backwards?
They're just showing.
I thought you tried to get creative and write it backwards because you thought it would be like an ambulance or something.
No,
Okay.
I should have
All right.
thought of that though. So this is Regulation A+, and
All
that's
right.
the law that's changing on the 19th. And if you take your offering and send it to the Securities Exchange Commission under Regulation A+, you can advertise all the live long day. You can take in any investor, practically any investor that you want. You don't have to get state approval, but what you do have to do, and this is a big thing, is you do have to get audited financial statements. So that's really the biggest obligation. And you do have some what are called ongoing reporting requirements, where you have to basically update the Securities Exchange Commission as to what you're up to every 6 months, saying, hey, this is what we're up to. But Regulation A+ allows you to advertise for investors, allows you to take in any investor you want, but you do have to get approval from the SEC before you start going out there and raising money.
Okay. And are there any rules that are different now in terms of you can fly under the radar if you're trying to raise a lower amount of money?
Not really. I mean, there is a thing called Title III under the Jobs Act. It's going to allow you to raise up to $1 million from almost any investor and use a crowdfunding platform where you can advertise your security, but you do have to use an approved crowdfunding platform. But that's not approved by the SEC yet, and we don't know when that is going to get approved. So kind of just waiting on that and see how that turns out.
So what is we have a number of even sponsors of the show that are crowdfunding platforms. So what is a approved crowdfunding platform? Is that a company, or is it a process, or what is?
Well, we don't know what it exactly looks like right now.
Oh, okay.
The folks who are out there crowdfunding right now, they're either using Regulation A or they're using 506C.
Okay.
Or in some cases they're using what's 506B as in boy, which is the old rule, because they already have a network of accredited investors, and so they're just going out to that network of accredited investors.
Okay. So let's just talk about the average person that doesn't want to go through a crowdfunding platform to raise money for themselves, not necessarily not use a crowdfunding platform as a lender, but to raise money. Just Joe Schmo that would like to raise $500,000, $1 million, couple $1 million to fund their business and their market. It's gotten easier, right?
It has gotten easier. I mean, again, I would say you should use, if that's the case, then try seeing if you can use 506C as in Charlie, because then you don't have to worry about general solicitation. But you do have to worry if your investors are accredited. If you have your favorite uncle is not accredited and you really want him to invest with you, then what you're going to want to use is 506B as in boy, where you can take in some unaccredited investors as long as they're sophisticated enough to know what they're getting into.
Okay.
And then you can also take in as many accredited investors as you want, but you can't use general solicitation with that one. So, but that to me, I mean, it's still probably the most popular type of filing we do, because we do have a lot of clients who have an existing network. They just want to tap into the existing network. They don't necessarily want to do general solicitation, or they're raising smaller amounts of capital, and so the 506B as in boy continues to make sense for them.
Okay.
So, yeah.
Okay. And in every instance, somebody needs to, this isn't a plug for your law firm, but everybody needs to work with an attorney.
Oh, yeah.
That, to get this kind of structured. It's not like you can just, well, somebody said 506C, so let me write that on my loan doc. Or, I mean, it's still a process of basically getting approval from the SEC, right?
Well, you're not getting approval from the SEC. It's more about you're protecting yourself from potential liability from investors who said, you didn't tell me that, I didn't know that. You definitely want to avoid that. Or from liability from the state or the federal government saying that I didn't, that you didn't provide the proper disclosure to your investors or file the appropriate exemption paperwork or the filing fee that might need to be filed. What I say to people is that you can pay a little bit of money to me now to help you do it the right way, or you can pay me a lot of money later to get you out of trouble.
Yeah.
So, and I'm not saying you have to pay me, but a securities attorney, and I particularly don't care to go to doctors. I don't know why. I have this unreasonable thing where I think I should be able to cure everything with ibuprofen. And sometimes, I have to come to the conclusion and the reality that that's not possible. I need professional help. Like, I cannot do my own appendectomy. So
don't try that.
Yeah, I would try that, and you shouldn't try it. Just like you shouldn't do your own securities documents. I really think even if you're raising a small amount of money, and quite frankly, no amount is too small, you should really just call a securities attorney and say, hey, look, what do you think I should do? And then determine, is the cost worth it, or should I try to go it alone? I mean, we do offerings as little as $250,000. Mm-hmm. So, don't think that I'm not raising enough money to call a securities attorney, because it's probably not true.
Yeah, the truth is anybody that you're looking to potentially raise money from will probably feel a much higher level of comfort if you have an attorney, then you have all the formal documents you need and all that stuff, and it's not just something that's on a legal tablet somewhere.
Oh yeah, and I'm never going to guarantee a client that they're going to raise gobs and gobs of capital, but I will tell them that it is a lot easier to raise gobs and gobs of capital when you do it the right way, because people are impressed that you spent the time, money, and energy to do it the right way.
Just look more professional, yeah.
Oh, absolutely.
Yeah.
Absolutely.
So what about, I don't know if I'm just curious, because I think some people are probably thinking this, and not to like pigeonhole you into like a cost thing, but if somebody wanted an offering to raise $250,000 to $1 million, I mean, what could they expect in total legal fees from any securities attorney to typically kind of get that packaged up and out the door?
Well, that's a great question. So I'm going to work backwards, and some of the numbers I might tell you would be a little scary. But typically, if somebody came to us and said, we're going to do a private placement memorandum, we're going to syndicate an apartment building, for example, our typical starting price is $15,000. If you just came in and said, I'm going to syndicate an apartment building, we would tell you, okay, that's going to cost you $15,000 for everything. But if somebody comes to me, and this is often, somebody comes to me and says, I only want to raise $250,000. I have 5 friends. We all want to get together, blah, 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 blah. Then typically what I would do is I would analyze how many investors do you have? What is their experience level? What can we get away with? Like, what's the minimum we can get away with and still be legal and still keep you safe from any liability? And so typically that price range is between $5,000 and $12,500. Okay. So yeah, that's what I would, typically speaking, if it's under $1 million, I try to keep it under $10,000.
Yeah. And I guess on some level, if you're going after private money, I don't know, what I'm about to say you may totally disagree with, that you're probably going going to find somebody that you can get better rates on than going to the hard money route if that's what you're doing now.
Yeah.
So there's some upfront expense to kind of get this set up where you can raise money, but it's probably at a much lower rate, so it would pay for itself probably after a few deals.
Oh, it does, because so one of my biggest hard money lenders right now is charging 15% and 5 points.
Oh my goodness.
So, and then what are my funds charging? My funds are 8%.
Yep.
8% preferred return with an equity kicker on the back end. So, the difference is you're going to definitely save the money in what you're paying out if you're used to using hard money.
Right. So for folks that, let's just say there's a lot of real estate investors that are mom and pops, they're buying, let's say 5 to 15 houses a year, house a month on average, that they may be rehabbing. What are the pros and cons? I mean, some people get so busy. I'm this way in my business. There's some things that I know I could save money on. It'd be more efficient, but there's this upfront work. It's like I've got to go through this process, and quite frankly, I just don't have time to do that right now, and so I push it off. But in terms of kind of level of difficulty to get somebody to a point to where they could raise money, which presumably would benefit them, what's the kind of level, aside from the cost, what's the level of effort to go through this process? And I know that's a very vague question.
Well, we try to do as much of from our point of view, we try to do as much as the work for you. All you have to do is think about your business. That's what we try to get you to do, is think about your business and how you want it to look. And then we've done so many of these that I kind of know what your answers are already going to be. So I just have to pull out and have you understand how it's going to work and what it's going to look like. So, for example, typically somebody will say, this is what I want to do in my business. And I'll say, okay, that's what you want to do in your business. So now here are some things to think about. Once you have a chance to think about those things, you now have given me just in our conversation have given me the framework by which I can write your documents without having to write anything down. The only thing, a lot of times, the only thing I ask people to write down is their biographical information and provide that to me. But or in some cases, like, again, I'll use the apartment building as an example. If they're purchasing an apartment building, send me all the information you have on the apartment building, and then I'll incorporate that into your documents. So, yeah. We can typically get something done, and it depends on how quickly the client acts, but we can typically get something done in 2 weeks.
Okay. And for people that go through this process and they get the kind of the legal ability to raise money, how long does that last? Is it what's the life of
the document?
The document, yeah.
First of all, a lot of it's up to you, but, we usually write them for 12 months and then extend them for 6 months with an optional extension of 6 months. But generally speaking, they can't last longer than 18 months because the document's stale. Because if you think about it, I'm making all this disclosure about your business and where you are and what you're doing and what the risks are. All of that hopefully would change from day one to the 18th month.
Right. But then if they wanted to refresh, I assume they don't have to start from scratch. It's just a matter of what are the new laws? What does your risk profile look like? Some of those things, right?
Right. So there's a couple things you can do. You can either, it really goes from client to client. We can discuss that with each individual client. Like, should you start another fund and separate assets out, or have interest rates going down? So should you start another fund and do a different interest rate or rate of return for your investors because their expectations should be lower at this point? Or do you want to cash out anybody out? Do you want to just continue on with this fund? There's a couple of things that we'd have to look at, but no, you don't necessarily have to start from scratch. And of course, we always offer a discount to repeat clients. So.
Yeah. So let's change gears a little bit, I guess, and talk about the difference between somebody that's looking to raise money for themselves, for their own projects, and somebody that's looking to raise money to then kind of re-lend out, as a hard money lender or something like that. So what are some of the differences there?
Well, it really there's not a whole lot of difference except in terms of what the business plan looks like and what the risk profile is. So, for example, if you're going to be a hard money lender, you don't necessarily have control over the end investment, whereas you do. So that's one of our risk factors there. Right. But, one of my hard money lenders, they pay out, a 12% preferred return flat. That's it. And then, as opposed to a lot of my property people who pay out an 8% plus equity upside, the hard money lender knows what they're going to make. Mm-hmm. they know because they know they're going to charge 15%, so the spread's 3.
Right.
You want to make 3, so they pay their investors 12, and so they can do that. Whereas an equity investor or a property owner, there could be a lot of upside or there could be a little upside, and so they can share that with their investors.
Right, right. So just from some of the clients you've worked with, there's a couple, maybe there's more than 2 different scenarios. So some people that I know have raised money. I'm just trying to think of how to structure this and determine in terms of how different people could structure things. Sometimes they raise money and it's in a fund and they're paying interest whether it's being used or not. Mm-hmm. And then sometimes you have almost like a revolving line of credit where you could put the money back in somewhere and therefore you're not paying interest on it. Of course, everybody would like to have that, right? You can put it back and I'm not paying interest on it. It's just sitting on the sidelines. Talk about those different structures and maybe anything else that I missed, and how common those are, I guess.
The bookkeeping for the second way is really difficult, or it can be very difficult. And then you have to trace people's money and things like that. And it becomes a pain more than it becomes an advantage. So this is what I typically recommend, that when somebody comes in and wants to invest in your company, you tell them that they're not going to start accruing a return until you actually invest the money. But once the money's invested, that's it. It's invested. It doesn't come in and out and in and out. It stays in. Yeah. So what you want to do is figure out, instead of on a per property basis, you want to figure out on an annual basis, how much am I going to yield this year? So yeah, I could make 25% return on investment on each property annualized, but if I skip a month between every property, then my return is drastically, on an annualized basis, is drastically reduced. So you want to take that number and then work backwards from there to figure out what you offer your investors, and that way you don't have to do that messy accounting. It's just, we're paying you 8%, 8%, 8%, and then if there's some distributions left over at the end of the year, maybe we'll give you some of those too.
Sure. Okay. So we've had a number of people on the show talk about using self-directed IRA money.
Right.
Does that change anything if you're looking to raise money from people that are using their self-directed IRA that maybe would invest in your fund? How does that, is that possible, or how does?
Oh yeah, it's absolutely possible. Okay. The big thing is the only problem is if you're a hard money lending fund versus a real estate holding company. Mm-hmm. If you're buying assets and they're your assets or the fund's assets, that can be considered a real estate operating company. So if it's a real estate operating company, it's pretty much exempt from ERISA laws, and anybody with a self-directed IRA or 401k can invest. However, if you have a hard money lending fund, a hard money lending fund is not going to be exempt under ERISA. So if you take in IRA or self-directed IRA money, you've got to be cautious not to take more than 25% of your investors as IRAs or self-directed IRAs or 401ks, because then you become a fiduciary to them. So real estate holding company, A-OK, take as much of it as you want. Hard money lending fund, make sure only 25% of your investors are actual retirement accounts.
Okay. Awesome. So what are we missing? Here? What other, after Regulation A+ comes out here in a few days, what's next?
I think that's going to be a real awesome advantage. I have a bunch of them going in the next week. I think it's going to be a great advantage to the real estate companies out there. If you're looking to raise more than $5 million, definitely look at a Regulation A+, because it will change your business in the way you raise money and capital.
Yeah. And these things are not just real estate based. These are crowdfund. These are the ability to raise money for anything. Business, essentially. Yeah.
Oh, anything. Yeah. Anything. I just anything. Yeah. So yeah.
We love real estate, so we talk about that all the time. But the reality is this is people can use this for anything. That's right. We ain't got time for nothing that's not about real estate. So
yeah, oh, that's terrible.
Yeah. So are there any? How do you think this is impacting just kind of the landscape of lending? Like, it just seems like, there's this obviously huge movement towards crowdfunding platforms and away from more traditional sources. Where do you kind of see things going?
I don't think, although I think Regulation A is awesome and 506C and a lot of things are coming out that are great from the Jobs Act, I don't think crowdfunding in the purest sense of the word is going to be the great savior of small business money raising that everybody thinks it's going to be, especially for the real estate investor. If you want to really expand your business beyond what you're currently doing, you're going to need more than crowdfunding. You're going to need like a long-term fundraising plan, and crowdfunding will, in a purest sense of the word, is not going to provide for that. So if you're going to use crowdfunding, think of how you can use crowdfunding in an expansive and growth-filled way, because otherwise it's not going to help your growth. It's going to truncate your growth because of the restrictions on the type of investors you can have and the amount of money you can raise. I mean, like I said, crowdfunding in the pure sense is only going to allow you to raise $1 million in a year. If you're any kind of real estate investor that's going to look to expand, you're going to be looking for more than $1 million a year eventually.
Yeah. Awesome. Well, so talk a little bit about a couple things. If folks want to kind of learn more, I know you guys have a lot of information on your website, tons of like white papers and lots of great information. Tell us again what the website is, where they would go.
Syndicationlawyers.com.
Okay.
So.
And in terms of just getting started, like people to get started, what are some of the general advice you give people to start thinking about and kind of researching whether this is something that they need to do or want to do?
Well, I would go to the website and read as much as you can because there's a lot of information there. But beyond that, I would also write your bio, write about who you are. And number 2, write bullet points of what you want to do with your business. And then think about how much money could I use in the next year to be successful? And start with that as your magic number. And then if that number is, more than $100,000 or let's just say more than $250,000, don't hesitate to call me and we can talk through your plan and see what the next step should be for you.
Okay, great. Hey, one more question. If you could just take a minute to talk to people about, you talk about writing your bio, and I think, in conversations like this, we always talk about raising money. A lot of people start to forget that they are they're kind of the point person. Like a big part of whether people invest or not is how much faith they have in that person, how much trust they have in that person. Maybe take a couple minutes to talk about some of the do's and don'ts in terms of kind of branding yourself to look like a reliable person to invest money in.
Okay, so this is great. So it's kind of the same way I run my own business. How do I get you to trust me? I could tell you about securities laws all day long. I could recite the Securities Act of 1933 for you, give you all the tips and tricks on money raising. Are you going to go out and get your law license and compete with me in that world? You can answer that question.
No.
Yeah. No, you're not. And likewise, if you tell I'm not telling everybody, give out your sources and give everybody your contact list or anything like that. But what I'm saying is if you go out and tell people what you're doing, what you're up to, educate them on how they can do it, then that's going to build trust. It's going to couch you as an expert, and people are going to believe you. It's going to give you credibility. Yeah. And at the end of the day, what's going to happen is people are going to see you know how to do it better than they do, and they're going to just want to write you a check because writing a check is easier than working. It really is. Yeah. So don't hesitate to share what's inside here because no one's going to steal it. They're not. It's simply not going to steal it.
Right.
It's easier for them to write you a check than to steal your information.
Yeah. And how about things like sharing, projects you've done and just kind of positioning yourself as an expert, like, hey, I'm trying to raise money now, but I've been doing this for a while and here's some examples of what we've done. Maybe talk about the importance of that. Almost creating like a resume, if you will, of what you've done and why somebody should trust you.
Well, that's exactly what you should do. And like one of my biggest money raisers was a guy who educated people on all he did was have multiple websites on how to invest in real estate with your self-directed IRA. So he'd write article after article after article on how to invest in real estate with your self-directed IRA. And then he would give examples of properties he had that were purchased and sold and rehabbed or what have you with self-directed IRA money. And he raised millions and millions of dollars just doing that, never asking anybody for a dime, just educating people on how to do it themselves.
Sure. Awesome. Well, Jillian, hey, thanks so much for your time today. It's good to see you again.
You too. Thank you for having me.
Yeah, and we'll add the link for syndication lawyers down below for those that want to learn more. I've looked at the site. It's terrific. It has a ton of information on there. So great way to educate yourself if you're looking to learn more. But Jillian, please stay in touch, and I'm sure we'll be talking again soon.
Thank you.
Have a good day.
You too.
Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.